it's a banking day, and amongst other things, we also caught up with Mr. V. Vaidyanathan. He's the Managing Director and CEO of IDFC First Bank. Let's hear out his view on Q1 earnings and, more importantly, the outlook for FY25.
Last quarter, when we were announcing results, we called out the fact that there were floods in Tamil Nadu, and there will be an impact on the books, but we had kept the amount open. So because we were still evaluating it. So basically we have the business, the microfinance business, where you lend to groups of borrowers and as a joint liability group. So we have that business that's about a 13,000 crore book for us. 60% of that is in Tamil Nadu. So in Tamil Nadu, the massive floods. So people at the bottom of the pyramid usually get impacted when these floods happen. So, we have a policy of just taking everything as they come. And we have disclosed it and we've taken the provisions for that. But it doesn't disturb fundamentally the core story of the bank and all that. All that is safe. This is one part of the pie.
Would you say this is a blip for the first quarter, or do you see the impact sort of flowing into the second quarter as well?
It will flow because as the portfolio ages and moves to the to later buckets, there will be certainly an impact next quarter also. Then Q3 it will taper off, and by Q4 it will vanish.
So, is that why Is that why you kept the credit cost guidance tight at 1.65? Is that why?
That's right. So basically, we are quite happy that the rest of the book, is really very strong. The rest of the book is like 94%. And that's like very, very good. Even this 6%, it's not that it's like completely blown up or anything like that. It's just that it has its, share of cycles. So let me say Q1, Q2, Q3 is a little more impact. Some, and then by Q4, hopefully it will just, wane away. And then we have guided 165 for the full year, excluding JLG. And for JLG, we've said 20 basis points. But frankly, even at 185 in today's credit conditions, it's a good number.
Yeah. Related to that, you've seen this across lenders, Q1 looking a little elevated on the asset quality front. Just tell me, to your mind as a banker, do you see that maybe the years of months and quarters of sliding gross NPA, maybe that's sort of over, and that we have to be okay with this is the level at best which the industry can operate at its maximum efficiency?
No, I don't think so. I like to put it like this. So basically, the normalization of credit will happen. Normalization means until last year we were having an NPA, but we're having a recovery from the past pools. So this time, there's no such recoveries because the books have whatever had to be recovered have broadly been recovered. So let me call it normalization of credit, and that's what is happening. But of course, we should always be very watchful. But there's nothing fundamental here that has got disturbed either for the system or anything like that.
Okay. A couple of questions around around your core business. Now, advances and deposits growth both have been strong on a YOY basis. Even QOQ, they're looking quite good. Tell us a little bit about what the rest of the year is going to look like on these fronts.
So our deposits have, as you know, have grown 39% YOY. I think it's really a strong number. And it's been running like this, growing like this for 5 years at a stretch. So it's not even a one-time event happening to us. More importantly, it's largely coming from retail. So that gives us that extra comfort. So this year, for rest of the year, we are planning to grow it at 30%, as in when you wake up in March 2025 and check against March 2024, we expect to have grown deposit by 30%. It should not be difficult when growing at 39. On the loan book, we will be growing somewhere around 22% in line with the guidance. So, if you grow 20, grow that at 30, the credit deposit ratio will further come down. It is our biggest objective to keep improving our credit deposit ratio.
On a period end basis, I think it's close to 100%, if I'm not wrong, your credit deposit ratio. Where do you want to see it? What is a healthy level for you?
First of all, the good news is it come below 100, like 99 something. And the context is very important. It was when we did the merger, because the DFI converting to a bank, we started at 160%. If you add credit substitutes, like lending to a corporate is also lending only. If you add that to credit, it's like 160%. It's now come down to below 100%. Now, 1 year forward, M25, we think like something like around 92%. Year after that, come to 80 something, 87, 88%. So within 2 years will be, the pace at which this has got fixed is really something to watch.
A quick question.
And the incremental credit deposit ratio for the last 1 year, 12 months, has been just 75%. So,
Right. Right. Okay. I want to take the NIM question next. Now, there's been a contraction on a QoQ basis, expected because you're seeing higher deposit growth and thereby more interest expenditure that is happening on every bank's portfolio. But do you think that maybe this is the bottom, or is there further sliding expected?
just a small correction there.
Sure.
From your understanding point of view.
Sure.
It's not because the deposits are growing.
Yeah.
It's more because the fact that our bank also had made certain investments in government bonds.
Right.
Because we had excess liquidity, and that was a good sort of it was making an extra income for us.
Correct.
That was a position our bond traders had taken. So that is why the NIM was affected a little. But otherwise, still at about 6.3% or 6.25%. I think it's a good number. We expect to roughly give or take sustain it for the rest of the year.
Okay. And lastly, with regard to the LCR framework that the RBI is proposing at this point in time, it's a draft framework, of course. Is there likely to be pressure? Because analysts seem to suggest that your bank will be one of the ones that will be hit if these guidelines do come in from 1st April.
I think maybe analysts put it out, but they didn't. I'm not sure what extent of research they did. I respect them, but I think I'll tell you the share numbers just for simplicity, and that will clear the air. Under the new framework, if we were to, assuming it comes into force, we think that the impact for us will be like 2 or 3 basis points, which means that to retain a healthy LCR, you will need about 10,000 crores more of deposits, and 10,000 crores or so. And for that, we'll probably borrow them in the differential between the rate we'll borrow is what we'll have to deploy in government securities or like at about 6.7%. That difference is about 70-80 basis points. That 70-80 basis points multiplied by 10,000 crores should be about 70-80 crore. It's not like for a large bank posting the kind of profits that we expect to post next year. It's not. We'll take it comfortably.